Welcome to Talk Tickers, where we break down the earnings calls that are moving the market. Today, we're jumping into Mercantile Bank's second quarter of 2025. And wow, what a day for the stock. This story is a perfect example of what really makes investors tick. So get this. On the surface, the news looked absolutely fantastic. They beat their earnings estimates, and they announced their first major acquisition in over a decade. The stock shot up in the pre-market, only to finish the day in the red. So what on earth happened? Let's dig in. All right, first things first, let's just look at the headline numbers. Because on paper, this quarter was a home run. No question about it. They reported GAAP earnings per share of $1.39. Now you have to understand, Wall Street was only looking for $1.24. So this wasn't just a beat. It was a 12% beat, a really strong bottom line. And it wasn't just the profits. The top line, their net revenue, came in at almost $61 million. That also topped what everyone was expecting and was up a solid 7.4% from last year. So more profit, more revenue? I mean, what's not to like, right? Well, here is that exact disconnect I was talking about. You could see it right here. Before the market even opened, traders loved the news, pushing the stock up over 2.5%. But then the earnings call started, management started talking, and that optimism, it just completely vanished. The stock ended the day down almost 2%. That reversal, that's the whole story. To figure out why that happened, we've got to look past the headlines and get into the two biggest themes from the call. A huge merger and the bank's core profit engine, which is called the net interest margin. You know, this quote from the CEO, Ray Ritzma, really says it all. The other massive piece of news was that they're buying another bank, Eastern Michigan Financial, or EFIN. And as he put it, this wasn't some desperate move. This was a strategic deal they have been waiting years and years to make. And when you look at the math behind the deal, you can see that long-term thinking at play. They expect this merger to boost their earnings per share by about 11% once it's all integrated. Now, the trade-off is a small, temporary dip in their book value, but they expect to earn that back in under 4 years. The big takeaway here is that it's a financially solid deal, but the real payoff, well, that's a few years down the road. But you know, this deal is about way more than just getting bigger. Yeah, sure, it brings in more low-cost deposits and expands their map. But the hidden gem, the really smart part, is the tech side of it. See, EFIN has been using this software called Jack Henry for decades, and that's the exact same system that Mercantile is planning a very expensive, very complicated switch to in 2027. This move basically buys them expertise and de-risks that whole project. It's a brilliant move. Okay, now let's talk about the bank's core business. This chart shows their net interest margin, or NIM. Just think of it as the bank's profit margin on its loans. And after a period of getting squeezed, you can see it's not only stabilized, but it's actually started to tick up for 2 quarters in a row. That upward trend is exactly what investors have been wanting to see. And this didn't just happen by magic. They were actively managing this. They've been tweaking their mix of deposits, carefully matching up their loans and their funding, and using swaps to protect themselves from interest rate swings. This proves they're steering the ship, not just getting tossed around by whatever the Fed does. So, we have a great quarter and a smart merger. Why in the world did the stock fall? Well, the answer wasn't in the press release. It was hidden in the forward-looking comments and the subtle clues from the Q&A session with analysts. First, look at this timeline. It shows that the real value from all this, it's a multi-year story. The merger closes later this year, sure. But the full cost savings don't even kick in until after that big tech conversion in 2027. And you know how Wall Street is. It can be pretty impatient. This timeline demands a long-term view. And here it is. This was the moment, the soundbite that killed the rally. During the Q&A, an analyst asked them how sensitive they are to interest rates. Management was honest and said that for every quarter point the Fed cuts rates, they expect their profit margin to shrink by about 3 to 4 basis points. In a market that is totally fixated on future rate cuts, putting a hard number on that headwind, well, that was enough to spook everybody. You can kind of see that context reflected in their official guidance, too. I mean, even though they think the margin will keep improving for the rest of this year, that rate cut comment just hangs over everything. You pair that with some other moderating income, and the outlook was, it was solid, but it wasn't perfect. Okay, so let's put it all together. We've got a great quarter, a smart long-term merger, and this short-term fear about interest rates that caused this crazy disconnect in the stock price. And that brings us to our final segment, the next call. So, the question every investor is asking themselves is, what do you do with this information? Is the market right to be nervous, or is this a huge opportunity? All right, here's our core thesis on this. We think the market completely overreacted. It's focusing way too much on that near-term rate sensitivity, and it's not giving nearly enough credit for the massive long-term value they're building with this merger and that de-risked tech upgrade. So based on that idea, here's how a potential trade could be structured. Step 1. The market's one-day panic basically gave you a cheaper price to get in. Step 2. The next big thing to watch for is the successful close of that merger late in the fourth quarter. And step 3 is all about validation. You watch the next earnings report to see if their profit margin holds up, which would prove those rate fears were overblown. So, tying this all together, our call is to rate Mercantile Bank as an outperform. We think the stock will get back to and push past its pre-call highs of around $50 a share once that merger officially closes. The single most important number to watch in their Q3 report is going to be that net interest margin. If it stays strong and within their guidance, it confirms our thesis that the market's fear was a short-term overreaction to a really strong long-term story. Of course, it goes without saying, but we have to say it. This is not financial advice. This is just our analysis of the earnings call to help you understand all the moving parts. You should always do your own research before making any investment decisions.